Today, we're going to dive deeper into mortgages by exploring additional concepts, analysis, and practical applications. We'll cover important topics like amortization schedules, refinancing options, building equity, managing risk, and developing effective long-term borrowing strategies. This session will give you a more comprehensive understanding of how mortgages work beyond the basics and help you make smarter financial decisions. Let's get started. When you look at a mortgage amortization schedule, one of the key things it reveals is how interest and principal payments change over time. Early in the loan term, interest makes up a larger portion of your monthly payment, which means your equity builds more slowly than many borrowers expect. As you continue making payments, the principal portion gradually increases, which is when you start seeing your loan balance decrease more meaningfully. This pattern is important because it helps you make smarter financial decisions. For example, understanding when you begin reducing the principal significantly can guide you in choosing when to refinance, whether to make extra payments, and how long you might want to keep the mortgage. Looking at the numbers, you can see that in the first year, a significant portion goes toward interest, with only a smaller chunk reducing the principal. By year 5, the principal payment grows, and by year 30, all your payments go toward the principal, meaning the loan is fully paid off. Overall, the amortization schedule transforms a regular monthly payment into a long-term financial strategy, showing you exactly how your mortgage evolves over time. This insight is crucial for managing your mortgage effectively and planning your financial future. Here, we're looking at how even small changes in interest rates can significantly impact a borrower's monthly mortgage payment over the life of the loan. For example, with a 30-year fixed mortgage of $400,000, as interest rates increase from 4% to 8%, the monthly payment jumps dramatically from about $1,910 up to nearly $2,935. That's an increase of over $1,000 each month. This steep curve highlights how higher rates reduce affordability and purchasing power. The key takeaway is that rising interest rates can push borrowers towards smaller homes, require larger down payments, or even cause them to delay their home purchase altogether. Understanding this impact is crucial for anyone considering a mortgage. Let's talk about the difference between fixed rate and adjustable rate mortgages. With a fixed rate mortgage, your interest rate stays the same for the entire loan term. This means your principal and interest payments are predictable and stable, making it easier to budget over the long term. Typically, fixed rate loans start with a higher interest rate compared to adjustable rate mortgages, but they provide consistency, which is ideal if you plan to stay in your home for a long time. On the other hand, adjustable rate mortgages often start with a lower interest rate that is fixed only for a short introductory period. After this period ends, the rate can reset either higher or lower depending on market conditions. This means your monthly payments could increase if market rates go up. ARMs are best suited for those who expect to move within a few years, plan to refinance, or are comfortable with some uncertainty in payments. So, if payment stability and long-term planning are your priorities, a fixed-rate mortgage is likely the better choice. But if you're looking for lower initial payments and flexibility, due to a shorter time horizon, an adjustable rate mortgage might make more sense. Let's talk about the common triggers that make refinancing your mortgage worth considering. First, when interest rates fall enough to lower your monthly payments, it's a good signal to evaluate refinancing. A smaller interest rate means you can either reduce your monthly cash outflow, making your budget easier to manage, or shorten the overall loan term, helping you pay off your mortgage faster. Second, if your credit score improves, you could qualify for better pricing. A stronger credit score can unlock lower interest rates and more favorable loan terms, which can translate into significant savings over the life of your loan. Third, when your home equity increases, your refinancing options expand as well. More equity can help you eliminate private mortgage insurance, support cash-out refinancing if you need access to funds, or simply improve your chances of getting your refinance approved. Overall, the best reason to refinance is to lower your costs or secure better loan terms that fit your financial goals. These three triggers, rates dropping, credit improving, and rising home equity, are key points to watch for when deciding whether refinancing makes sense for you. Here, we're focusing on how to calculate the break-even point when refinancing a mortgage. The break-even point is the time it takes for the savings from a lower monthly payment to cover the closing costs of refinancing. You calculate it by dividing the closing costs by the monthly payment savings. For example, if your closing costs are $4,440 and your monthly savings are $185, you divide $4,440 by $185. That gives you about 24 months. This means it will take 2 years for the savings to cover the refinancing costs. Understanding this break-even point is crucial because it helps you decide if refinancing makes financial sense in your situation. If you plan to stay in your home longer than the break-even period, refinancing could save you money in the long run. Let's talk about private mortgage insurance, or PMI, and when it applies and can end. Typically, conventional loans require PMI when the initial down payment is less than 20%. This insurance protects the lender in case the borrower defaults. PMI is added to your monthly mortgage payment and stays there until you've paid down enough of the loan principal. Over time, as you pay down the loan, your equity increases and the loan-to-value ratio improves. Once your loan balance reaches about 80% of the home's value, you can usually request to have PMI removed. Most lenders will automatically terminate PMI when the balance hits 78% loan-to-value. To give you a better sense of cost, on a $300,000 loan with a 0.5% annual PMI rate, you're looking at roughly $125 extra per month. On a larger $450,000 loan with a higher 0.8% annual PMI rate, that monthly cost could be around $300. PMI rates generally range from 0.3% to 1.5% annually and depend on factors like your credit score, down payment, and loan structure. Understanding how PMI works and when it can be eliminated can help you better manage your mortgage costs over time. Let's take a closer look at how paying points affects your mortgage. Points are upfront fees you pay to reduce your interest rate. Typically, 1 point costs 1% of your loan amount at closing. For a $300,000 loan, that means paying $3,000 upfront for 1 point. By paying points, you can lower your interest rate and reduce your monthly payment. For example, if you pay 1 point, your rate might drop from 6.75% to 6.50%, saving you about $51 a month. 2 points would lower the rate further to 6.25%, saving around $101 per month. However, paying points only makes sense if you plan to keep the mortgage long enough to recoup this upfront cost through monthly savings. In this scenario, dividing the $3,000 cost by the $51 monthly savings gives a break-even point of about 59 months, or just under 5 years. So, if you plan to stay in the home beyond this period, buying points will start to save you money overall. On the other hand, if you think you might move, refinance, or sell before then, paying points may not be worth it. It's important to weigh these factors carefully before deciding. Home equity represents the portion of your property that you actually own outright, which means it's the current value of your home minus what you still owe on your mortgage. So, if you think about it in simple terms, equity equals your home's value minus your mortgage balance. Now, when your home's price increases, your equity grows as well. In fact, the equity gain can be calculated by multiplying the price increase by your ownership share. This means that any rise in property value directly enhances your equity. Leverage plays a crucial role here. When you use a mortgage to finance your home, leverage can amplify your gains if property values go up. However, it also means that losses can be magnified if property values decline, because you still owe the mortgage regardless of market fluctuations. Understanding both home equity and the effect of leverage is essential to managing your mortgage and making informed decisions about your property investments. Here, we're comparing two main types of home equity financing: home equity lines of credit, or HELOCs, and home equity loans. Starting with HELOCs, these are revolving lines of credit, meaning you can borrow as needed up to a certain limit during a draw period, typically with a variable interest rate. They're ideal for ongoing or uncertain expenses because you only pay interest on what you actually use. This flexibility is a major advantage. However, the downside is that your payments can increase if interest rates rise or if you borrow more, which could pose a payment risk. On the other hand, a home equity loan provides a lump sum upfront. usually with a fixed interest rate and set monthly payments. This makes it better suited for one-time, clearly defined expenses. The predictability of fixed payments makes budgeting easier. The trade-off is it's less flexible if your project costs change after you've secured the loan. Ultimately, the choice between these two loan types comes down to whether you prioritize flexibility or certainty in your borrowing needs, especially when leveraging the value built up in your home. Here, we're looking at the concept of the debt-to-income ratio, or DTI, which is a crucial factor in mortgage approvals. Essentially, your DTI is calculated by dividing your monthly debt payments by your gross monthly income. This gives lenders a clear picture of your financial obligations relative to your income. A lower DTI means you have more room to comfortably take on a new mortgage payment, which lenders view favorably. Generally, lenders look for a DTI below 36%, which is considered comfortable and increases the likelihood of stronger loan approvals. A DTI around 43% is often treated as a common ceiling. Loans with this ratio may still be approved, but typically require compensating factors like a larger down payment or higher credit scores. Above 43%, however, your DTI is seen as risky, meaning lenders are more cautious because your existing debt takes up a significant portion of your income. Understanding where your DTI stands can really help you gauge your mortgage approval chances and make informed financial decisions. When it comes to property appraisal and valuation, there are four key factors that appraisers consider. First is the condition of the property. This includes the age of the home, how well it has been maintained, any upgrades that have been made, and the overall structural quality. All these aspects directly affect the appraised value. Second is location. The demand of the neighborhood, the quality of local schools, nearby amenities, and the general market appeal all influence how much a property can be priced for. Third, appraisers look at comparables or comps. These are similar homes in size, style, and features that serve as benchmarks to determine value. Lastly, recent sales data provide the most concrete evidence. The prices that similar homes in the nearby area actually sold for recently are crucial to estimating market value accurately. By combining details about the property itself with real, local sales data, appraisers can deliver a reliable estimate of market value. This approach ensures that the appraisal reflects the current market conditions and property specifics. The loan-to-value ratio, or LTV, is a key factor in mortgage lending. It compares a loan amount to the home's appraised value or purchase price. This ratio helps lenders assess risk and set pricing. Generally, a lower LTV means less risk for the lender and often results in better interest rates for the borrower. When you have more equity in your home, that is, when the loan amount is smaller relative to the home's value, the lender has a bigger cushion if property values decline. Another important point is mortgage insurance, or PMI. If your LTV is above 80%, lenders typically require PMI to protect themselves against default. However, as you pay down your loan and your LTV drops below that 80% mark, PMI can often be removed or no longer be necessary. This 80% threshold is a common standard, but you may also hear about other LTV percentages like 60% or 95%, depending on the situation. Overall, a lower LTV position means you're viewed as a stronger borrower, which benefits you with better terms and potentially lower costs. Now, let's talk about some common types of mortgage fraud and how to recognize and prevent them. First, there's stated income fraud, where the borrower exaggerates their income to qualify for a larger loan than they should. This can lead to serious trouble down the line if the loan amount isn't sustainable. Next is appraisal inflation, which involves pushing the property value above its true market worth. This can mislead lenders and buyers alike, causing financial risk. Then we have identity theft, where someone uses a borrower's personal information to open or alter mortgage files without their consent. To spot these red flags and prevent fraud, it's essential to review every document carefully and never sign anything that's blank or has unexplained changes. Always question numbers that seem inflated. Income, assets, and property value should be supported by strong evidence. Protecting personal data is critical too. Verify the legitimacy of lenders and keep sensitive records secure. Finally, always work with licensed professionals. Make sure brokers, appraisers, and agents have verified credentials. These steps help safeguard both borrowers and lenders from potential fraud risks. Now, let's dive into government-backed mortgages, which are important options for many home buyers. First, the FHA loan offers lower down payment options and more flexible credit requirements, making it especially popular with first-time buyers. However, it usually requires mortgage insurance, so that's something to keep in mind. Next is the VA loan, which is designed for eligible veterans and service members. A major benefit here is that it often requires no down payment and doesn't have monthly private mortgage insurance, although a funding fee may apply. Lastly, the USDA loan is targeted at buyers in qualified rural and suburban areas. This program also offers zero down payment financing, but comes with income limits and is intended for primary residences. Each of these mortgage types has unique features tailored to specific borrower needs, so understanding these can really help make homeownership more accessible. Here's a detailed comparison between conforming and jumbo loans. Conforming loans follow agency-backed standards, which means their interest rates are usually lower and their pricing is more standardized. These loans often require a down payment between 3 to 5%, though it can be higher if there's additional risk from credit issues or occupancy. On the other hand, jumbo loans exceed the conforming loan limits, such as the 2024 baseline limit of $766,550 in most markets. Because they involve larger balances, jumbo loans usually require a larger down payment, often between 10 to 20% or more. Their approval process is typically longer, involving manual reviews and asset scrutiny, since lenders take on more risk and rely heavily on borrower strength and their own appetite for these loans. Interest rates for jumbo loans can be higher, and the underwriting process tends to be tighter, with more focus on reserves and credit. In summary, conforming loans offer standard pricing and broader eligibility, making them easier to sell on the secondary market. Jumbo loans, by contrast, come with stricter credit and income requirements, higher down payments, and a more involved approval timeline. Understanding these differences is key when evaluating mortgage options above the conforming limits. When you make your monthly mortgage payment, it typically includes more than just the principal and interest. You also pay a set amount each month for property taxes and insurance. These funds are held in what's called an escrow account. Your lender collects these amounts separately and holds them in this account as your bills accumulate throughout the year. Then, when property taxes and insurance premiums are due, the escrow account disburses the necessary funds on your behalf. This system helps smooth out what could be large, unpredictable annual bills into manageable, consistent monthly payments. It's important to remember that paying into escrow doesn't mean your taxes or insurance go away. Rather, escrow handles the scheduling and payment, so you don't have to worry about missing deadlines or making lump sum payments. When you're buying a home, understanding closing costs is crucial because they can add a significant amount to your overall expenses. For a typical $400,000 purchase, closing costs usually range from 2% to 5% of the loan amount, which in this example totals about $12,400. Let's break down what makes up this total. First, lender fees, which cover things like loan origination and processing, are around $3,000. That's about 24% of the total closing costs. Next, title and settlement services come in at roughly $2,500, or 20%. These fees relate to the legal aspects of transferring ownership and ensuring the title is clear. Prepaid taxes and insurance constitute the largest portion here at $3,300, approximately 26%. This covers advance payments required for property taxes and homeowners insurance. Then we have appraisal, credit report, and recording fees, around $1,600 or 16%, which are necessary to verify the home's value and properly record a transaction. Finally, escrow funding fees, which are about $2,000 or 14%, cover setting up the escrow account for future payments. A key tip is to ask for the loan estimate early in the process. This document gives you a clear picture of the fees involved, allowing you to compare offers and avoid surprises at closing. Being well informed helps you make confident decisions as you move forward with your mortgage. Here, we're looking at two important documents involved in a mortgage agreement: the mortgage note and the deed of trust. The mortgage note is essentially the borrower's legal promise to repay the loan according to the specified terms. It outlines the obligations and a repayment plan. On the other hand, The deed of trust is a document that secures the loan by placing a security interest in the property, meaning the lender has rights to the property until the debt is fully paid off. It's also important to note that mortgage laws vary by state. Some states use a traditional mortgage, while others use a deed of trust, which involves a third-party trustee to hold the legal title until the loan is satisfied. Understanding these documents and state variations is crucial for anyone dealing with mortgages. When facing the possibility of foreclosure, it's crucial to act early because more options are available before the foreclosure process is complete. Missing payments often trigger notices and late fees, so as soon as you realize there might be a problem, contact your loan servicer immediately. This early communication can open doors to solutions. The foreclosure process itself involves legal action that could ultimately lead to the sale of the home. Timelines for this process vary depending on the state you live in and the type of loan you have, so it's important to understand your specific situation. In terms of alternatives, there are several options to explore. You might seek a loan modification or a repayment plan to catch up on missed payments. If those aren't viable, you could consider a short sale or a deed in lieu of foreclosure, which means handing the property back to the lender to avoid the sale process. The best chance of resolving the issue is by addressing these options before the sale date. Acting early and exploring these alternatives can help avoid the loss of your home and reduce financial hardship. Now let's talk about prepayment penalties, an important aspect to understand when managing your mortgage. Some loans charge a fee if you pay off the balance too early, typically within the first 2 to 5 years. These penalties often take the form of charging 6 months interest or a fixed percentage of the remaining balance. For instance, a 2% penalty on a $300,000 payoff would cost you $6,000. This can significantly reduce or even erase the savings you were hoping to achieve by refinancing, selling early, or making a large lump sum payment. So it's crucial to check your loan note before taking any of these steps. On the other hand, many standard conforming loans don't have any prepayment penalties, which provides more flexibility. Beyond penalties, making extra principal payments can be a great strategy to save money over the life of your loan. Even small monthly additions can reduce the term of your 30-year mortgage by years and cut down the total interest paid substantially. For example, adding an extra $100 per month might reduce your loan term by 3 years and save you around $61,000 in interest. Increasing that to $250 monthly could cut the term by 7 years and save over $100,000 in interest. Just remember, extra payments only help if your loan terms allow them without triggering penalties. So, it's all about knowing your mortgage specifics to make the best decisions. Mortgage rates tend to move in sync with a broader macroeconomic cycle. Central to this dynamic is Federal Reserve policy, which often influences borrowing costs across the curve. When the Fed adopts a tighter policy, it usually means higher borrowing costs. Inflation also plays a key role. As inflation increases, yields generally rise too, which in turn weakens affordability for borrowers. Meanwhile, strong job growth can keep mortgage rates elevated, even if housing demand softens. So, it's important to watch inflation levels, Fed guidance, and Treasury yields together to get a clearer market read. Looking at the historical trend from 2019 through 2025, you can see how different events impacted rates. The pandemic drove rates down sharply. Then the inflation spike pushed them up, followed by an aggressive Fed tightening cycle. More recently, as inflation started to cool, some pressure eased, but rates remained relatively high. This slide illustrates the close relationship between 30-year mortgage rates, inflation, and Fed fund rates over time. Understanding these connections helps us analyze and anticipate changes in mortgage markets more effectively. When we talk about building wealth through real estate equity, it's important to understand how every payment you make works in your favor. Each time you make a mortgage payment, you're not just covering interest, you're actually increasing your ownership stake in the property. Over time, this principal reduction combined with the natural appreciation of property value and strategic borrowing can transform your home into a powerful long-term wealth building tool. First, think of forced savings. Your monthly mortgage payments steadily convert what used to be debt into own value, helping you build equity without having to consciously set aside extra cash. Second, leverage plays a crucial role. With just a modest down payment, you can control a much larger asset, allowing you to benefit from the property's full appreciation, not just your initial investment. Finally, appreciation means that as property values rise over time, your net worth can grow significantly beyond the amount you've paid down on your mortgage. So, in essence, your equity grows from two sources: the amount you pay down and the increasing value of the property itself, making real estate a unique and effective way to build wealth over the long term. Now, let's talk about some important tax deductions available to homeowners. First up, mortgage interest is a key deduction that can significantly reduce your taxable income. When you pay interest on your mortgage, a portion of it may be deductible, which can lead to substantial savings. Next, property taxes paid on your home are also typically deductible, helping to lower your overall tax bill. Another important deduction is mortgage insurance premiums, which traditionally were deductible under certain conditions, though there are limits. However, it's crucial to keep in mind that these benefits can phase out or reach caps depending on your income level and specific circumstances. Also, most homeowners need to itemize their deductions rather than taking the standard deduction in order to claim these benefits. Understanding these deductions in detail can help you maximize your tax benefits related to homeownership. When it comes to mortgage documentation and compliance, having complete and consistent paperwork is absolutely essential. Key documents like proof of income, bank statements, employment verification, and identification all play critical roles in the process. These documents ensure that underwriting moves smoothly and significantly reduce any compliance risks. Accuracy in gathering and submitting this information is crucial, as it speeds up the approval process and helps avoid unnecessary delays. Using a core file checklist can help keep track of all required documents, making sure nothing is overlooked. Ultimately, the quality and completeness of your documentation make a big difference in the success of the mortgage application. As we wrap up, let's focus on some key takeaways and important action steps. First, always take the time to read the amortization schedule carefully, not just the monthly payment amount. This gives you a clearer picture of how your loan balance changes over time. Next, only consider refinancing if the savings you gain outweigh the total costs involved. Refinancing isn't always beneficial. To build equity faster, it helps to be disciplined, stay consistent with payments, and whenever possible, make extra principal contributions. It's also crucial to understand the rules around loans, such as loan-to-value ratios, debt-to-income limits, necessary disclosures, and keeping an eye out for any fraud red flags. Finally, when planning your mortgage, remember to account for all the full costs involved, including taxes, insurance, escrow, and closing fees. By acting with clarity and understanding these concepts, you'll be in a much stronger position to manage your mortgage effectively